Hey traders, Raghi here and welcome to the premium video. So we've got our April Fool's joke on the bulls or on the bears. I'm not quite sure who got the brunt of it, but we'll talk about the intraday alerts that I sent out today. And on the list of discussion will be crude, bonds, the S&P, both intraday and end of day, since we did both those, we've been talking about both those trades. European markets, mostly the EWG, but we'll talk about FXI as well. Make coffee, how to look at large gaps and how to fade them, which I think is what we saw in the open today. The gold alert that I sent out, as well as the XLK alert that I sent out as well. All right, let's get to it, shall we? All right, so a few levels to keep in mind, and I don't think we're just going to tank from here as much as I, on one hand, want to see that. On the other hand, I do want to see a few levels get possibly retested. We're very early in the month. So one thing that I'll be looking for, and let's kind of put this out as in alert format, and this is going to be the NASDAQ futures setup. On the this is going to be not just any NASDAQ setup, it's going to be the June NASDAQ futures setup. Okay, and this is going to be a short or a sell of the NQM20. That means the NASDAQ June and of course the year 20 NASDAQ June contract. We're going to sell it at, and I'm really looking for something. Now look at where we bounced up to. Where have we gone consistently? About that 78.80 area. So I'm cool with 78.80 on a bounce. That'd be a limit, and that would be too open. Now, for those of you that are curious, okay, Rob, this could entail a lot of risk. It sure could. We're trying to short from as high as we can. But note, when this trade, and this is going to be kind of some more insight, when this trade fires off, there will also be strength in the QQQ and XLK. The XLK we already have interest in. So the XLK could be an opportunity for those puts. For the alert I already sent out for the puts. Okay? Keep that in mind. One of the reasons we like XLK, it does not have Amazon in it, and Amazon's been a relative outperformer. So we're looking at that on the NQ. All right, then moving on over to the S&P. The S&P has been in action a little bit more around the 21 EMA, not so much the 34 EMA on the high. So if we have a relative outperformer, it's the NASDAQ, and if we have a relative underperformer, it's the Russell. So this is the June futures contract, and we're looking to sell the ESM20. And I'm looking at this, as you can see right in this area, I'm looking at this to be around the Darvis level, and that's the 2640 area. Okay, so 2640. That would be on a limit. That would be, of course, to open. But remember, again, just like in the case of the NASDAQ, this would also be in this zone, or as we trade higher into 2640, that bullish momentum allows us to bid on puts in the in the ES or SPY. Now, if we get up there, I'll send those out as alerts, but I want you guys thinking about this because, today, I think about this with today's intraday trades, for example, and we'll come back to this conversation, but I think about today's intraday trades. Let's talk about the gaps for a moment. So today we had a significant gap, right? And typically, so we've talked about gaps before. So let me kind of zoom in here and show you kind of the psychology of a gap. A lot of traders want to fade the gap. It's not that different. If you guys remember when we had all those limit moves, on the reopen, I would talk about the first 1 to 3 minutes, the first 60 to 180 seconds after. It's not that different with large gaps and the open. So, you think about, all right, this was my low, and then 180 seconds in, this is my high area. And that zone here to about here, what you'll typically see, and there's no perfect way of saying it. You could say 1 to 5 minutes, which would put the breakout here. But when we take out a certain high, all of a sudden you'll see the momentum come in. And that's really, so rather than just simply buying the market on the bell on that large gap down, I'll wait about 1 to 3 to 5 minutes for a range to form. Now, this is very much kind of what we talked about when we had the limit fades, the limit move fades. But this is not that different than that 5-minute setting on the Waikiki, right? So those of you that remember, our Waikiki clearing range tool has a 5-minute, a 15-minute, and a 30. Now that 5 and 15 were times that I looked at because Neil mentioned, the ranges we see in those areas, our very own Mr. Neil Yeager. And so I look at the 5 and the 15, but we haven't done that in a while. On the gap open for bullishness, some traders might have thought, you know what, Rog, we could fade this move. That's not going to be what I prefer to do. Although, just like in a limit situation, the gap fade is probably pretty actively traded. But because we had calm doll weakness and yen strength, my thinking was, let's get this gap, let's let the folks fade this gap, and then we'll step in and we'll short this market at resistance levels, right? We'll short this market at resistance levels. We had a couple opportunities in this area, but what happened instead? Golly, well, some of you know already, we just kept going and going and going and going. And so when we see a move that starts to exceed the expected price movement ranges, starts to look like this market wants to climb, even though the yen strength and the calm doll weakness still was something that was intact, this market started acting disconnected again. And I'm not going to sit through more heat than an hourly price movement range would justify for this trade. So really, really frustrating because right from the bat, I wanted to short this market and everyone can see what happened subsequent to that. So yen's revenge, probably. Calm doll revenge, probably. But I will say what is promising is that we're starting to behave a little bit more respecting the currencies, but I think that large gap probably created a little bit more bullishness than, I might have underestimated that. So I did put in the notes, and these are the notes that are sent out to you all. So I did put in the notes, what do you do with a large gap open, right? It's a lot like the limit move. So in the first minute of trade, it's about 1 to 3 to say 5 minutes, you'll typically see these highs that will trigger these momentum plays. And that I expected, right? But how much they kept going was the issue. I think we let that little momentum play happen, saw the move higher, and then thought, okay, now we fade. And then, well, you guys know what happened after that. So I put some updated notes in here. Do check it out. It's going to give you something to refer back to. And we'll be right back at it tomorrow. Same approach, okay? But pretty darn frustrating. And this was both, ES and YM that I wanted to do this in. And just super frustrating in the way that the market sort of over-exaggerated the initial gap fade, then turned into a little bit of a morning uptrend before absolutely getting slam dunked the remainder of the session, that's the kind of price action, right, we were looking for. Get this out of the way, get this nonsense out of the way, and this was what we were looking for. And so pretty frustrating for me to look at the price action there. Okay, so we have a lot of questions on the request for different markets to look at here. And let's start it off with the 30-year bond. Okay, so 30-year bond, it's up. There's nothing really to do here, gang, because if you're looking at a 1-minute chart and you're thinking, well, the 1 minute was showing a lot of weakness, that doesn't necessarily pertain to levels that we're interested in. What are the levels that we're interested in? The 13 EMA, the 21 EMA, the 34 EMA on the wave. So as a day trade, the bonds might be interesting, but as an end of day buy, it has not sold off enough. One market that's getting very close to selling off enough is the gold market. So I sent out an alert about gold and using the 1575 level on GCM, the June contract of gold, in order to, one, get long and buy GLD calls. Now, some of you might say, but Rog, this is not the lower end of the range, and it's not. We could look for another lower end of the range in this area, but we can put a stop just below. This is the value area high here, gang. We could put a stop just below the value area high and then, recalibrate if we need to at a lower low. But I do want to put a little skin in the game in this area, hence that alert. Okay, so it's not the bottom of the range, but I think it is a level that merits our attention. Okay, I talked about Germany and China briefly this morning in the chat. And yes, I still want to short Germany on rallies, 100%. I might even be interested in France, EWQ on rallies. I'm interested in shorting China, FXI. Look, the world is not out of the macroeconomic downfall woods. The world is not out of even the health crisis woods. Shorts in equities around the globe, I think, are very much ripe for shorts. You can look at the EWY. This is the South Korea ETF. So there's a lot of countries. We've talked about this before, the different country ETFs. I'm absolutely interested in which countries. And again, we started off, if you recall, when the coronavirus hit, what we wanted to do was play the knock-on effect geographically and from a trade perspective focused on China. Who knew all those weeks later we'd be talking about the US, but initially what did we do? Let's short Australia, let's short South Korea, let's short Hong Kong, let's short Singapore. Then it turned into let's short Germany, right? So we started looking at just central, kind of geographically focused on that area. And then also why Germany? Because 30% of its GDP goes to China. So we focused there, and then who knew we'd be looking at the kind of drop we're seeing in global equities. The US was the last one. We started with the initial, sort of what they call knock-on effects. And I'm still interested in shorting rallies in these markets. All right. Okay, next is a question about coffee. All right. So softs have been actually, generally speaking, ripping higher. Softs have been very strong. We had a list of softs that we were interested in that I sent out as an alert not all that long ago, but the problem with softs is this. A, they're very volatile. B, they're going to be subjected to the strong dollar, which I'm still very much a fan of the strong dollar. And C, you need this ICE exchange, which is going to run you $125 a month to keep this exchange running on your brokerage platform so you can execute the trades and see the live quotes. Now, some brokerages will let you execute in exchanges that you are not paying a subscription to, but most will not. So it's a little cost prohibitive. It's a little access-wise prohibitive. And so I don't make a lot of softs, but I'm not crazy about what I'm seeing in coffee right now, although it would be arguably if somebody said, Rog, you got to take a position right now, it would be a buy coffee. But I think the downtrend in sugar has been relentless. The downtrend in sugar. I haven't really been watching sugar, coffee, cocoa as of late. I really haven't. The main trade that I've been watching is really more ag related, like soybeans, shorting soybeans, shorting lean hogs, and shorting cattle. And we'll probably look at that ag trade again. The same day that China rallies if for any reason that we might be interested in the FXI short or even the EWG short is very likely going to be the same day we end up looking at shorts and beans and hogs, the pork and bean trade as it's known. All right. Okay, so that pretty much brings us up to speed on what I've got my eye on. We're starting off the new month. For those of you that studied some of the notes on the month-end phenomena, we probably saw one of the most intense month-end last 3 days phenomena. When I say intense, it's the disconnect that's really jarring. It's the disconnect that's a problem, not the volatility. Volatility is fine. The sell-off that we saw today in the afternoon or late mid-morning to afternoon was perfect. It's what we saw in terms of early bond strength, early yen strength, and early com doll weakness. That makes sense. The early strength is what didn't make sense. Although, as I've explained here, and I got into more detail on the notes, this could have been a little bit more exaggerated, a fade on the gap. I would still play today exactly like I played it, but I think the bigger difference, and we'll talk about this tomorrow, is using options. The QQQ, SPY, IWM, DIA, ESNQ, YMRTY, using options in an environment where the support and resistance is a little bit more elastic. Heck, even the relationship back to some of the more, things like the yen and the com dolls, again, even more elastic. So I think when I look at ultimately what we have today, I think the market did what it's supposed to do. It exhausted on the daily levels. I think the day trades were difficult, but we're going to persist with the plan. Check out the notes. I think they're going to help a lot, and I'll see you in the next update.